Chapter 21. Is the Housing Bubble Popping? This chapter was previously published in August 2005. Friday, August 5th, 2005, was a bad day for housing stocks, and this could be a sign that the housing bubble may have sprung its first leak. This is what the Philadelphia Stock Exchange Housing Sector Index looks like this week, losing about 5% for the week. Investors have made around 50% on their money since I first reported on the housing bubble, and there could very well be more bubbling to come. In this graph of high-flying Toll Brothers, TOL, one of the largest home-building companies, the stock has increased by over 50% in the last year. Optimists point to the company's price-to-earnings ratio of only 15, which is below the market average. The pessimists' case for a bursting or deflating of the housing bubble is the issue of rising interest rates. As Greenspan increases short-term interest rates, it causes problems for those who have variable-rate mortgages tied to short-term interest rates. Energy prices and a slowdown in the economy can also dampen enthusiasm in the housing sector. The larger problem may be for long-term rates, because they are the foundation for fixed mortgage rates. As Greenspan increases short-term rates, the thinking goes that he is reducing inflation expectations, and thus reducing the likelihood of increases in long-term rates. However, if long-term rates rise, this is an indication that short-term rates are not rising fast enough to dampen inflationary price pressures. Long-term interest rates are rising, and there was a big increase in the interest rate on 10-year Treasury bonds on Friday, August 5th, that coincided with the fall in homebuilder stocks. Over the last summer, this interest rate made a double bottom at around 3.9%, which is almost the lowest it has been in my lifetime. It is now 4.4% and probably headed higher. Note it was 5.25% a year later. A double bottom is a term from technical stock analysis that is a bullish indicator, which in this case predicts higher long-term interest rates. Higher rates spell trouble for the home builders and give some indication the housing bubble might be coming to an end. Hopefully, Alan Greenspan will know the correct lever to pull next. He did in the 1960s. Postscript. If you look at a long-term chart of the Philadelphia Stock Exchange Housing Sector Index, symbol HGX, you will see that this was indeed the exact turning point for homebuilder stocks, which typically lead the actual housing market. The Taylor Rule, a guide to monetary policy, can also be said to have predicted the housing bubble financial crisis. Thomas Woods' book Meltdown is the best analysis of the housing bubble, financial crisis, and the policy response to it.